if you can create if you create a mindfulness, creates a space between your experience of the world and your reaction to the world. And if in that space, you can choose a better action, that is success. Will you be able to choose a better action every time? No. Sometimes you'll still screw up. You'll make mistakes. We all make mistakes. But if we can improve a little bit, we can vastly improve our outcomes.
Welcome to the Bulletproof Cashflow podcast. Let's get into the show.
Hey everyone, this is Augustino. Money drives many of our decisions. Oftentimes we worry about making it, spending it, investing it, regardless of our income level. However, very few of us actually understand the true nature of what money is and what it can do for us. Well, today's guest has a very deep understanding of these concepts and has helped thousands of people create unique financial plans that shows people how to save, invest, pay off debt, and fund their retirement to build a lifetime income stream. In 2001, he founded DeYoe Wealth Management with the mission to offer independent financial advice and unparalleled customer service in a client-centered environment. He's also the author of the Amazon best-selling book, Mindful Money, and he speaks to thousands of people on the intersection between money and mindfulness. Today, he and his team manage close to $250 million for nearly 235 families and entities across the United States. With all that, I'd like to welcome my very good friend, Jonathan DeYoe, to the show. Hey, Jonathan, thanks for coming on, man.
Thanks for having me, Augustino. I'm excited to be here.
Yeah, it's going to be great. It's going to be great. Well, if you like what Jonathan has to say, you can reach him via his website at DeYoeWealthManagement.com. If you like our content, please don't forget to leave a comment and rate the show. It helps us out tremendously. Finally, if you text the word freedom to 202-410-4202, you get our free ebook, The Bulletproof Guide to Finding a Broker. Okay, Jonathan, go ahead and tell the listeners a little bit more about your background.
So there's a background, a lot of different things here. I started off, actually, I traded my first stock when I was 9 years old. My dad actually, to fit in with the scope of your podcast, my dad actually was a real estate investor. I grew up reading all the books on how to build wealth with real estate. I've got a whole library. I've got probably 60 books on how to build wealth with real estate. And so I was raised with this idea of invest for the future, invest for the future, invest for the future. And I happened to fall in love with the stock market and how to invest in great businesses of the United States and the world. And I did that for a while, and I got really excited about it in high school and had a great economics professor, and I learned a lot. And I started off my college career thinking about finance specifically, and I started studying finance, and I got really bored with it. It was just, I've done all this stuff. I've read tons of information, tons of research on equities, tons of these books on how to raise money and how to build money and build wealth with real estate. And then in college, they say, okay, now I got to go to, Finance 101, learn how to, balance your checkbook. And I got really bored. So I started studying philosophy and religious studies. And, you referenced DeYoe Wealth Management as the company. We're actually going through a huge rebrand. The title of the book is Mindful Money. The new company, in which by the time this podcast goes live, DeYoe Wealth Management will probably be no more, and it will be mindful.money. And what that does is it brings together the philosophies of mindfulness and the deep student of finance, and offers that to clients and through our educational courses and through all the other things we're going to do to help out folks in the community, both build wealth, drive themselves in a career, and save and invest for their futures and their families' futures.
Excellent. So what does that mean then when you say mindful money? In what context should people really be thinking when they hear you say something like that? What does that mean?
Mindfulness in the context of personal finance has the same definition as it does, in every other part of life. So just a quick definition. Mindfulness is the non-judgmental awareness of the present moment as it's experienced by our five senses and our minds, our thoughts and our feelings. Now, mindfulness is the recognition of the reality before we apply our narratives. Okay. So long ago, we're talking 40 years ago, 50 years ago, the economists believe in a rational person, man, woman, that, gathered all the data, really studied and researched all the data and made really intelligent, rational choices based on that data. And then you fast forward maybe 20, 30 years from that point, this is maybe 10 or 15 years ago, and Daniel Kahneman and Amos Tversky did a lot of their research on behavioral finance. And behavioral finance is born. What behavioral finance tells us is we're not rational. We are infected with all of these cognitive and emotional biases that make us do things that hurt us. We don't actually know what we want. We can't keep the things that we want in our brains. And when we're met with all this stimulus from outside, in the outside world, whether it's markets going up or markets going down, or something happens in our family, or we get emotional and we make decisions out of that emotional place. What's more is the behavioral economists tell us that there's nothing you can do about that. You can be aware of it, but there's nothing you can do about that. And that's where 7 years of specific study of mindfulness and academic study of Buddhism specifically, but there's this thing called phenomenology, how we experience the world, and then the application of 25 years of meditation, and then working with hundreds of families on how they experience money and make decisions around money, teach me that there is something we can do. And the thing we can do starts with that awareness, starts with the mindfulness of the biases that we have. And then I don't know if you know this, but the simple act, and if you read any of the great financiers of today, they all meditate. Now, why? What is the fundamental reason for meditation in the realm of finance? By the way, it works in your relationships, it works at work, it works in everything else in your life as well. But why in finance? Well, it's really interesting that the research tells us, if you spend 10 minutes a day staring at a wall, reflecting, just paying attention to your breath, returning your thoughts to your breath, something simple like that, 10 minutes a day, you're actually increasing the size of your frontal cortex, the actual mass of your decision-making part of your brain, and you're decreasing your size of the amygdala, which is the part of your brain that is responsive, reactive, and fight or flight. And by decreasing your amygdala and increasing your frontal cortex, you're actually enabling your brain to make more rational choices. So in this way, I know this is a long way around, but in this way, mindfulness is a doorway to more rational financial choices.
That's excellent stuff. And the thing is that if you understand Daniel Kahneman's work and you spend some time studying it, you also get to understand the cognitive biases, which I think he touched on as well, right?
Tons of them, yeah.
And it sounds to me like spending some time within yourself and really performing the meditations, performing the introspective, I guess if you want to call it thinking around it, and understanding what the cognitive biases are and how they affect you. Do you think there is a way to somehow control it? Because I have to imagine that years ago, when I was working in corporate America, I would often, just like you said, fall back on the emotional side of things. And I think many people out there that are listening to this podcast right now, they probably feel the same way. But understanding how the cognitive biases work is enormous, right? But getting back to the point of the question, is there a way to control some of those wacky emotions that might try to come up and really bite you if you take the wrong action or cause you to take the wrong action by doing some of the things that you're just mentioning right now?
Of course. So that's where the rubber hits the road, right? So Jonathan, it's an interesting theory. You meditate, you end up, with the ability to make these better decisions. Great. So I guess there's another part of this, and there's the other part of it is, and I think, I've listened to a few of your podcasts in the past, and there's a lot of the background in, if you're going to invest in anything, is you have to understand what you're investing in. So my space is the great businesses of the United States and the world, often referred to as the stock market, right? And when you say the stock market, it already dredges up a whole bunch of crap in people's minds about what that means. But really what it is it's just great businesses, right? So the reality is, and there's this quote, and I can't remember the guy's name. I think it's Tim Maudlin, actually, who said something to the effect that people are gullible. Humans can be duped by liars and conned by frauds, manipulated by rhetoric, and beguiled by self-regard. They can be browbeaten and cajoled, seduced, intimidated, flattered, wheedled and ensnared. In this respect, humans are unique in the animal kingdom, something like that. And his point there is, if you don't understand what's happening, then someone else has an opinion. You hear that opinion will move you. And in the financial world, specifically, if you pay attention to CNBC or if you read the financial press or the headlines, you can just remember this. And this is, if you go back 3 months, it was the end of the financial world as we knew it, right? COVID, 20%, 34% decline in 30 days. The world fell apart. Everyone freaked out. And I don't know if you read this, Fidelity, 30% of Fidelity's customers that are 65 or older sold all of their equities at the bottom, liquidated, went to cash. Now, that is a behavioral mistake. That is, and we see that happen over and over and over. But why did they do it? Well, they did it because A, they didn't understand. They didn't understand how companies are valued. And B, they were terrified because they were listening to all these other people. So if you can create if you create a mindfulness, creates a space between your experience of the world and your reaction to the world. And if in that space you can choose a better action, that is success. Will you be able to choose better action every time? No. Sometimes you'll still screw up. You'll make mistakes. We all make mistakes. But if we can improve a little bit, we can vastly improve our outcomes.
Wow. And it is very powerful stuff. In our world, in our space 3 months ago, what we do as multifamily syndicators is we basically turned off the spigot in terms of providing our investors their returns just for that quarter, right? The reason being is because we weren't sure where the markets are going to be going. And part of it is our job is to protect the asset, right? Our job is to manage the asset, not just for us, but for all the investors, right? And meanwhile, there are people out there, some YouTube talking heads saying, oh my God, look at these syndicators. They're holding back money. Look at them. Look how bad they are. No, any responsible syndicator, any of them, and I know a lot of them, we all did the same thing, right? We all held back. And when everything turned back to normal, we sent out distributions again. That's what we did, right? Everyone did this. It's like the common practice. And that isn't because we all just got together and just said, this is how we're going to do it. It just made sense to do it. But in the case of what you just described, my God, those people just sold all their stuff basically out of fear. I mean, that was the motivation. And that is totally the wrong way to do it. I mean, that's a good way to lose the nest egg that you spent your whole life building. Terrible. I'm not laughing at it. It could really bite you. But it sounds to me like what you do, Jonathan, is you really help people navigate the sort of rough patches that like we're going through right now, right? It's a rough patch. It's not going to be like this forever, but you're helping people navigate that, right?
Yeah, of course. I mean, there's an enormous amount of, and it's like 60 years people have been investing with this idea of 60, maybe 7 years ago, the capital asset pricing model was created, and this idea of creating a diversified asset allocated portfolio came into being. And there's been tons and tons of research since then, and all the research tells us there's some very, very simple, basic things that we can do that provide an opportunity for better long-term returns. The problem is from day to day, and you got to remember that before COVID, there was 11 years of just really fantastic market, like a really, really fantastic market with no, 1 year was, I think it was 2018 was down 4 or 5% in the market, but every other year was positive, no big drawdowns. So this was it was very, very sharp, very, very painful, very, very fast. B, it was the first one we've had in 12 years. So it took it's a long time since we've experienced this. But in that period of time after 2008, people were like, okay, I remember how this is supposed to be done. I'm going to do my asset allocation. I'm going to have some bonds in here. I'm going to put some, international stocks in here. I'm going to be broadly diversified. I'm going to do this in an intelligent way. And then, 2013, 2014, 2015 goes by, and they go, you know what? My bonds are kind of a drag. They're pulling down my performance. I want to have more of the juice. I want to have more of these .com. It's not .com anymore. It's FANG, right? I want to have more Facebook, more Apple, more Google, more Netflix, because that's where all the returns are coming from. And then they sell out of the internet. Why do we own international? It's like it's doing horribly compared to the U.S. Why would I own that? So they sell out of that, and they give up on diversification, and they give up on asset allocation. And then they get more and more and more concentrated over that 11-year period until it hits, COVID hits, or whatever the thing is at that period hits, things go down, people freak out, they make their behavioral mistakes, and now they go, maybe I should think about that thing we talked about 11 years ago and get asset allocated again. Maybe I should, be more diversified. Maybe I should rebalance, do something simple, not try to predict or prognosticate what the markets are going to do, but just rebalance. Just do something really simple. Maybe I should think about tax management. Maybe I should think about these 4 or 5 very simple things that are easy to implement that actually work long term, rather than focusing so much on the short term decisions.
Yes. And speaking of the recession, and let's talk about that for a second. Do you think that, given that where people were talking prior to the pandemic, that this recession is like a welcome thing? If you think about it for a second, we had a long bull run. Everybody's like, oh, there's a recession coming. There's a recession coming. We think it's going to be student housing. We think it's going to be credit card debt. We think it's going to be school loans. We don't know. And all of a sudden it's this. Nobody saw it coming out. But is it like one of those welcome things because now it's done and it's over with? Or like, what are you seeing? What are your clients saying? Are they like, I'm not going to say they're relieved, but now they're like, okay, now we know what it is. How much longer is this going to go on for? And can we just get everything back up to the way it was prior to it? Like, is there any of that as far as how they're allocating their assets on a go forward basis?
So, if you go back to March, like when we were at the bottom, March, early April, and there was a question about, oh my God, how long is this going to last? How bad is it going to get? We didn't know it was going to turn right away. Mm-hmm. If you go back to that point, then I think what you just said actually carries a lot of weight. People are like, oh, you know what? We needed a reason for this thing to reset. We needed a reason. And this is an awful reason. People are actually dying. There's a lot of infections. It's actually really a bad thing, right? For humans. Businesses respond accordingly, right? They laid off a whole bunch of people. They cut their costs, just like you're doing with your syndications of real estate, right? You've got to hoard capital. You don't know how long you're gonna have to wait till you start getting rents again. So you have to be careful on your distributions, which makes perfect sense. It's a business thing. It's a thing that businesses have to do. Individuals do the same thing, right? They stop spending as much. Obviously, no one's traveling, but we stopped buying our toys as much. Things like new car purchases went way down. Things like new shoes went way down. And now we're seeing some of those things come back up. But I think now we're 3 months, 2.5 months past that bottom part now. And because the markets have recovered so quickly and so far, now there's a question. And the thing I hear people asking more often than not is the market ahead of itself? It's not, oh, thank goodness it went down. It's like, why is it back up so fast? Like, why did this thing recover so quickly? And that's a really good question. But if you think about, there's sort of 3 basic places you can put money. You can put money in businesses. You can buy real estate. Everything else is some function of cash or fixed income, right? So there's, in that area where most of the money went in March and April, and there's been, like, I think April, we saw, I don't remember what the exact number is, we saw $600 billion go into cash, go into checking and savings accounts. That's a month. There has not been a year in history when that's happened. Like, so in 1 month, we had more money go into people's bank accounts than has ever gone into their bank accounts in a year prior. That's how terrified people were. They were so scared, they just put all their money in cash. And what is cash paying again? Like 0.000,
That's
right? So if you think about where can you put money, and you go, well, if I'm going to put in cash, or if I put in a 10-year risk-free treasury and it's going to pay me 0.5 for 10 years, it's guaranteeing a loss of my purchasing power over the next 10 years. Why would I do that? Well, what else am I going to do? It's stocks or real estate. That's businesses, sometimes publicly traded, sometimes private, or real estate. That's your only other option. So I think the reason it's recovered so quickly is because people had all kinds of money. They had nowhere to put it. They needed some return. So they had to put it somewhere that would give them some return. Is it easier? You tell me. Is it easier to buy a piece of real estate, or is it easier to buy a stock, or something that's publicly traded?
Right. Yeah. It's super easy to buy a stock. Yeah. Of course.
So easy.
Of course,
right.
Yeah.
So you don't have to go into analysis. So I think maybe over the next 3, 6, 12 months, you'll see some of that money come out because it's looking for opportunity and it prefers real estate. And some of the money in real estate, the money goes between real estate and stocks all the time. I've got clients who do both all the time. But yeah, I think the question now isn't the sense of, oh, thank goodness that hit. It's, wow, it hit. And why did it recover so quick?
That's interesting. So are you thinking then that this recovery isn't a real recovery? It's just a continuation of what things were pre-pandemic, and there's still another potential recession coming? Or do you think that this is the big one, in air quotes, that people have been waiting for and are now like restarted the counter, so to speak? We're back to zero, and we're going to start counting from here for another 7 to 10 years.
So I don't want to be I don't want to offend my host, but I'm going to say something here. Okay, there's a fundamental belief that there's something coming. And that happens. It doesn't matter what the time is, whether the market, if you remember, before the market was that high, we're all worried that it's down. So it must be going to go down further. But then when it's up, it's got to come down soon, right? The bias is towards the belief that it's going to come down at some point. Okay. And the question you just asked is, well, Jonathan, so it's recovered. Do you think it's going to go down next? I have no idea. Here's what I know. This is what I know. I know that about every year from peak to trough, the stock market declines about 15%. Every single year from a high point that year to a low point that year, it goes down 15%. Normal volatility. Nothing to be afraid of, nothing to be concerned about, totally normal. Every 3 years, 4 years, it goes down 20% on average, So it happens on a regular basis. It's something you can predict, and not something you can predict, strike that. You can't predict it, but you can expect it, right? Mm-hmm. Every 5 or 6 years, it goes down 33, 34% on average. Some of those get as bad as 50, 55% every 5, 6 years. And that's normal volatility. I'm not investing in the next 2, 3, 4 years. And it's hard to say this and convince people of how true it is. But I don't care what the volatility is over the next 3 years. I'm not investing for the next 3 years. I'm investing for the next 30 years. Here's what I believe is going to happen in the next 30 years. Market's going to be up 10x in the next 30 years. And if I look at the day my father was born in 1942 compared to the day I was born in 1971, that's about 30 years. It's 10x. The day I was born versus the day my son was born, which is about 33 years, it was about 10x. The day my son was born to today is about 15 years. It's about 6x. So it's over a long period of time, markets do incredibly well at accreting wealth, right? Over the short period of time, I have no clue, but I expect it'll be volatile.
Right.
And I'm not trying to predict. Prediction is the problem.
Yeah. Yeah. What you're doing is you're doing, it's a long-term hold. And that's the way investors should be thinking, is long-term. This isn't, it isn't like you're in there trying to buy and sell all the time. I mean, unless you're day trading and you're trying to, that's a whole different game altogether. That's not what you're into. You're not.
It's a failed game. That game doesn't work. I mean, I don't know, yes, there are, this is the interesting part, is you put all the day traders on a bell curve. You're going to have some of them that do really, really, really well. Now, you also have some that do equally badly. All right. And you have a whole bunch of people that are kind of in the middle that do less than break even, maybe make a little bit of money, but so those people on the extremes, were they really good or were they really lucky? Research says they're really lucky, right? So it's a game that people play that I don't think you can be successful at consistently. You can be occasionally successful, but not consistently.
Right. No, I stay away from all that stuff. I did that when I was in my 20s. I tried that. No, I'll never do that.
So did I.
Nope. Now for me, it's all about real estate. It's real estate, in especially when it comes to triple net leases, for instance, very, very, very predictable. Good for cash flow. There's that asset class, and of course, there's all the syndications that we're doing too, which again, a whole different asset. But in your case, though, what you're doing is you're helping people not only with the stock side of things, but you're also helping them with the real estate side. I mean, you're basically the one-stop shop as far as helping people build overall wealth, right? It isn't like you have a bias towards just stocks only or anything else like that, right?
No, so in 2001, I started the company in 2001. I left Wall Street firms and started my own company in 2001. That same year, I embarked upon a path, the path that I had read about in my dad's books as a kid. And I purchased one piece of real estate a year for about 6 years. And I think that's great. I have since actually gotten out of much of my real estate. This isn't a judgment about real estate. It's a time management challenge. And I know that I'm sure that it's this way for you. It's this way for most of my clients that actually have real estate is as they get a little bit older and they're managing that real estate, even if they have managers in place, you still have to put effort into it. You still have to do some work for it. And for me, my bias is more towards the freedom that I get from a portfolio. And I've actually transitioned some of that real estate assets into private businesses. Like I've got a buddy who I'm a partner in his game store. I've got a friend of mine who I'm a partner in his chip design. He runs a chip design company. I got a buddy and I've invested in their businesses. So I invest a lot in private business rather than public business. I do both. I still own a bunch of real estate. I believe in both. I help clients not manage, but acquire. We'll help them not as real estate agents, but how does it fit into the big picture plan? My personal bias, I love businesses. However, if you buy for what you're doing, if you're buying a syndicated or piece of syndicated real estate, it's a business. You own shares of a business, basically. Yeah. Right. So it's the same concept.
Yeah. Excellent. So if someone's listening out there right now and they were maybe considering trying to do some of the things that you're doing, try to be a little more mindful around their investments, what sort of suggestions do you have for someone that's just starting out that wants to be a little more mindful, aside from practicing meditations, maybe becoming familiar with the cognitive biases, which you can, if you just Google cognitive biases, there's plenty of people that write about them. There's videos on YouTube. You can sit back and watch them. Everyone should be familiar with how these cognitive biases works because media uses them on you, the listener, every single day. I promise they do. They do. So for someone listening out there, Jonathan, how before they're calling you up and asking you for help, maybe they're not at that stage yet, what should they be doing? Like, what should they be thinking about to be more mindful about their money?
It's a great question. I think it's the question, actually. And just how, I think we referenced this earlier right at the very beginning of this conversation, in meditation, you have to have an anchor point. And in meditation, for me, when I meditate, I anchor often on my breath. There's lots of, you can do a body scan, lots of different kind of meditations. The most often or most accepted form of anchor is your breath because it's constant. It's always there. It's in, it's out, it's in, it's out. So it's a very simple thing to anchor on. So in personal finance, you can't just, okay, markets went down, I'm going to focus on my breath. You need to have something to anchor on. So the thing I think acts as a really good anchor in personal finance is a personal financial plan, comprehensive plan. And what that means is you have to go through a process of understanding the trade-offs you are going to make for your life. In other words, I work a job, that job pays me $50,000 a year. Of that $50,000, I'm going to commit $500 a month to my 401k. I'm going to get a 3% match on that. So I'm going to commit, what is that? $500 a month plus $100 a match. So I'm going to have $600 a month going to my savings. Okay. So if I do that every month for the next 30 years, what kind of pool of capital is that going to provide? And will that be enough? Oh, it won't be enough? Well, then I probably have to trade something else away so I can save more so that it can be enough. You have to do the analysis to know how much cash you're going to need for the rest of your life and do a plan. So you're making sure you're putting that away. Now, once you know how much you should be putting away, the activity you should engage in is putting it away. You should actually do the things the plan calls for and ignore the rest. The stuff that's going on in media about finance is almost always complete noise. You can ignore the vast majority of it. If you're one of the day traders you referenced, then you got to worry about what this stock does or that stock does. But if you're just a broadly allocated, broadly diversified investor, you don't have to think about it that much. In fact, it doesn't help you to think about it that much. And frankly, it doesn't help the day trader either. They have the illusion that it helps them. So you have to create this anchor point. For me, that anchor point is a financial plan. If you don't have a planner, then you need to have some kind of a process to do it. The reason I wrote the book, if you look at the last section in every chapter in the book, there's an exercise. If you go through every exercise in Mindful Money, the book, at the end of the book, you have a basic financial plan. The point is, I can't help everyone. I want to help more people. The book was my first step towards impacting more lives, to give people the ability to create their own financial plan.
Excellent. And I think part of it too is you have to be prepared to make a sacrifice as well. Like, for instance, for some people out there, maybe they don't want to become the next real estate mogul, but rather they just want to have enough socked away so they could retire comfortably. But what that also means is, in order to get that type of savings, you either need to take a side hustle or need to do something else over and above what you're currently doing. And that means watching less TV or doing more of the quote fun things, so you could really be mindful about your future as opposed to living for today. Instead of living a very Epicurean sort of life, right? Totally
agree. Yeah, it's you, and we talk about it in terms of trade-offs. You have to know what your trade-offs are, and then you actually have to make your trade-offs. And there's this huge, and you can put it in anything. I really want to be a better husband. Well, what are the kinds of things a better husband will do? Well, a better husband might compliment more, maybe do more of the work around the house, maybe just volunteer to do more stuff. So then I want to be that. Well, so that means I got to not sit down in front of the TV so I can help make dinner, or I've got to, make sure that my wife has a break on, whatever. So I can be a better person, but it's actually the doing part that makes it happen. Right. And that's true with relationships. It's true with your health. Oftentimes people, in your first question, I could easily go to this place of how do you get a start. When I was young, I just worked. And I got really big. I was very, very, very overweight, and I wasn't very successful. And the minute, literally like 6 months within me taking my health seriously, my relationship turned around, my business turned around, everything turned around. So it was something about having that health focus enabled so much more. And that's part mindfulness. It's part, just doing the work. You got to do the work.
Yeah. I mean, would you say though that for many of us that really fall into the 40-hour matrix is what I'm calling it, where the predefined plan that's prescribed to everyone from when we're kids, myself included, was, do the 40-hour job, go work at some company for 40 years, and then you're going to retire and that's it. Then that's life. It's game over after that. Do you think that is where the mindfulness part is really, really falls apart there? I mean, as opposed to what you just described, and many people fall into that same sort of thing. They get overweight. They're not happy with their lives, and they end up just going with the flow, so to speak, right? Do you find a lot of that happens?
So I have one of my best friends in the world. It's funny because I've embarked upon this, invest in real estate, start a company, build a business, and I've worked to make that happen. I think he was my sophomore. No. He was my 8th grade science partner, 9th grade science partner, right? This is a guy I've known for a long, long, long time, right? Love him to death. Really one of my best friends. He didn't embark on this, doesn't invest in real estate. All he's ever done is contributed to his 401k. He's at the same company right now where he started 30 years ago. Same company. All he's done for 30 years is put money into his 401k. He's gotten his match. He keeps putting money in. He takes vacations. He's made the trade-off. I know how much I need to put away. He puts away that much. Every other penny that comes in, he can spend on whatever toy he wants. He's got a Jeep. He's got a fancy car. He takes vacations with his family. He does all the things that you want to do. But he's consistently put money in his 401k. And now he's got a pool of capital that he's not retired yet, but 10 years from now, when he is retired, he'll retire way before I will. And he will have a pool of capital that he won't be able to outlive. He'll also nicely have a pension, which is something that I'll never see. And you'll probably never see. Like, pension is not something that's in the world anymore.
Yeah.
But I don't think there's any problem with taking that route. The thing he invested in, though, was he invested in the great companies of the United States and the world. Like, he invested in stocks, and he did it on a regular basis, twice a month for 30 years. Now, is it sexy? No, it's actually really, really simple. If you just do it, it still works. I think it'll work over the next 30 years if you do it that way. It's not my way. I actually like running a business. I like employing people. I like working with people and mentoring and supporting, and I like working with clients. And I also, I contribute to our 401k. But it's, for me, it's building the business and building a portfolio of real estate is done really well. And I will continue doing that. Right.
Yeah. Well, in your friend's case, though, he also followed a plan. And, for him, he's happy doing what he's doing. He's going to be just fine for him and his family. And that's okay. That's fine, too. No, not
totally fine.
Someone's got to be doing the 40-hour jobs.
Yeah. And he loves it. I mean, He loves it. He wouldn't trade it. That's right. He doesn't have to deal with the technology issues we had to deal with getting on.
That's right. See, that's exactly it. They go in there, they do their thing, they go home, and they spend time with their family, and then build. There's nothing wrong with building a life like that. Absolutely.
It's a beautiful thing.
Yes. So I know you touched on some of Daniel Kahneman's work. What other books, what other resources do you find are great? What other books do you actually like to read and enjoy and often share with other people?
I think the ones I share the most often are, do you know Stephen Pressfield at all?
Yeah.
The War of Art.
Yep.
I just yesterday I was thinking about the book because my son he's a singer-songwriter. He's 15. He plays guitar and he sings. He's got a beautiful voice, and so it's a struggle, to set up your YouTube channel and to record music and learn how to use GarageBand. And it's all a huge challenge. And the War of Art basically says, if you're gonna be a creative, you're going to have to overcome tons of struggles. And I think it works in our business. I think it's one of the best books for small business owners to read is Stephen Pressfield's War of Art. And he had a second one. It was equally good. I'm losing the title right now, but the War of Art's awesome.
Yes. I actually read that one. It's very, very good. Yeah. I highly recommend that one. Yes. All right, guys. Well, if you want to reach out to Jonathan, you can reach him through his new site at mindful.money. I think DeYoeWealthManagement.com will probably redirect there. Hope you're able to implement some of these simple practices for reaching your financial goals and really increasing your happiness dividend. Take care of yourself out there, guys, and I'll see you in the next episode.
Thank you for listening. We hope you enjoyed the Bulletproof Cashflow podcast.